Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest in the show, just head on over to missionmatters.com and click on Be Our Guest to apply. All right, so today I have Alexandra McGuigan on the line, and she is head of APAC over at Q Blue Balanced. And this episode is part of our iConnections Miami series where we bring you the best of those that participated and attended in iConnections. So, Alexandra, welcome to the show.
Thank you very much. Very excited to be here.
All right, so we got a lot to talk about today. First off, though, to get us kicked off, I know we met and connected through iConnections over in Miami. So you were in attendance. I always like to start this series off like that. What was your experience like? Like, is this your first time? Have you been before? Give me some of the backstory.
So I've actually known the iConnections people since they set up the business. So
Mm,
I was working at 100 Women in Finance many years ago, and that they hosted a cap intro conference for female portfolio managers.
mm,
So met the team many years ago. So have been involved in the conferences, the physical conferences after COVID, right since the outset. But this
yeah.
was my first time in Miami, and it definitely impressed.
Well, so you've obviously seen evolutions, different formats. What stuck out to you about Miami, just in general?
Well, so they have an APAC one as well, which is obviously for the region, but we get investors and asset owners from all around the world coming to Singapore for the conference. But it's on a much smaller scale because there's less fund managers in the region than there are in the US. So Miami was a little bit like a rock concert and a cap intro conference and a finance conference all in one go. It was brilliant.
Yeah, it was. I agree, and there was even just the people that come out for it, the whole thing. And so it's become. This is my first year actually covering this particular event, but I cover like FII Priority in Miami and the Milken Conference in Beverly Hills, and in other
Yeah.
locations abroad in Singapore. Like we did the Asia Summit last year. I think we're. I think
Okay.
that's on the agenda for this year coming up too. So, but this iConnections thing, and then the app, and the connection, the connecting through that, and being able to kind of sift through, in my case, who I wanted to interview versus, and in the case of allocators or other individuals, being able to connect. Can you talk about like the meeting component of it? Because I'm always interested on the other side, like how their experiences are, like just the meetings that are set up.
Yeah, so we had a lot of meetings. I mean, we're a very institutional
Hmm.
asset manager. So our offering is quite complex, and so
Yeah.
it's not for everybody. So some
So
managers will get.
sifting is important, right? Like you got to get to the right conversations to be worth your time, right?
Absolutely, and the conversations were with the people that we had conversations with were the biggest institutional allocators. And interestingly enough, though, a lot of them were European and from APAC because they know us a bit better. We did have two big North
So you
American
got to
ones,
come to
but
Miami to meet with people in Europe from Europe, right?
yeah, well, I mean, I guess it just everybody's there, right? So you bump into people. I bumped into one of the CIOs from the big family offices from Melbourne, and he was like, "Alex, it's great to see you." Anyway, we ended up hanging out and having a full like hour and a half meeting with him and my CEO. So that was you kind of
Wow.
just have to be in the room as well. So you have the meetings that are booked are excellent,
Hmm.
but then being in the room and just bumping into people is also like the reason you go, I guess.
Yeah, I'll tell you, I know, and we'll switch from this topic briefly, but I want a good buddy of mine. He's in LA. I swear we live like 5 miles from each other. We haven't seen each other all year. We're always like, oh, this, that, whatever. And then all of a sudden I see him here and I'm like, come on, really? We got to go across the country from LA to here. We
Yeah,
live 5 miles away from each other.
I know.
So, all right. So, all right, moving on. I think that was a great transition. Not my random story, but what you were talking about
Yeah.
being very institutionally focused. Maybe
Yes.
give us a little bit of background on Q Blue Balanced.
Okay. So Kubler Balanced is a Danish asset management, systematic asset manager. And there's not that many asset managers in Denmark, just in case you didn't know that. But it came out of a team at a Danish, like a very famous Danish pension fund called ATP. And
Hmm.
so the CEO and founder is a man named Bjarne Graven Larsen, and he was the first chief investment officer at ATP. in Denmark. And as the story goes, he said that, they said, oh, well, what expected returns can we get? And he goes, well, I'm an economist. I can't tell you about returns, but I can tell you about risk and what you should be worried about.
Yeah.
And so right from the outset, I mean, there is a bit more story to it in terms of regulation, but right from the
Mhm.
outset, they set up ATP in a risk-based allocation approach. And so
Mm.
so that is what has actually become known as total portfolio approach, which is definitely having a moment now in institutional business. So anyway, long story short, he built this team, hired these amazing guys, and so it's the same team that has been working together since the early 2000s in this risk-based allocation total portfolio way. And then
Mhm.
in 2017, the systematic team, so the quant guys, spun out because there was a regulatory change in Denmark, which meant that they couldn't do some of the things that they had traditionally been doing. So they spun out and started the business Q Blue Balanced. While at the same time, Bjarne he'd left ATP in 2011, and then he went on and did a bank turnaround. And then he was actually hired as the chief investment officer at Ontario Teachers Pension Plan
Mm.
to do. And he told me this like 2018, and I didn't really understand the whole approach because I'm a marketer, not a quant.
Mhm.
But he said that they hired him to do the same thing that he'd done at ATP. And
Mhm.
essentially what that was at the time, Ontario Teachers was a mature pension fund. And so they were already in the decumulation period. So that means that obviously they have more money outflowing to
Mhm.
pay retirees than is coming in.
Right.
And at the time, and he's written about this in a white paper, they had a very siloed business, which is what you can think about as strategic asset allocation. But
Right.
once your remuneration is based around the
Distributions.
well, no, the pot of capital that you look after, you want to have as
Mhm.
much money as possible to make as much money as possible, right? So that becomes a difficult proposition to try and get people to work together at the top level to improve the incremental difference of the portfolio.
Mm.
And so he talks about how they at Ontario Teachers Pension Plan, it was a completely different approach to total portfolio approach where they had to adjust the culture and get the heads of asset classes working together.
Mm.
And so he did that anyway. He left there for family reasons and moved back in 2018 to Denmark and joined forces with his former team. And that's what Q Blue Balanced is.
Mm. Total portfolio approach or TPA having its moment right now. Like,
Yeah.
can you go a little bit further into that and why that is?
So I think that and I've just put a post on LinkedIn this morning because there's a lot of confusion around what total portfolio approach is and whether it's one versus the other. Whereas from what I've learned from being in a lot of meetings with a lot of with Bjarne and a lot of institutional allocators is it's rather a framework that you can add additionally to look at
Mhm.
things and ensure that you are understanding what risks there are in your portfolio and making sure that you're being compensated for those risks. And so traditionally asset classes like real estate, for example, that actually has components of the returns of a real estate investment is actually being driven by three different things. There is equity market risk. So if things are doing well, then your property is probably going to go up in price. There's interest rate risk. And so that's related to the interest you're paying on your mortgage, etc. And then there's inflation risk. And so because it's a real asset, you have an inflation hedge. So total portfolio approach is actually going, okay, so rather than saying I have a building, it's
Mhm.
saying what is driving the returns of this building and making sure that you are compensated for all of those different risks in your portfolio and that they're
Mhm.
so it's just a way of looking at things in addition to what you already have.
Mm. And so why would they start to veer and start to maybe adopt some more of this approach? Not necessarily versus another, but like where does it fit in their overall scheme of things or even their overall allocation? Like where should it fit?
So it's probably more every organization is going to be different, and that is going
Of
to be
course.
different based on the regulation. It's going to be different based on where they are in their lifetime. And so breaking it down into three things that you have to answer first. First is, what is your objective? And so the paper that Bjarne talks about, their objective was to make sure that they could meet the retirement requirements of the people that they were providing capital to in an inflation-adjusted way. So then what is the mathematical or what is the outcome, and how much do you have to achieve if that's your objective, is to meet the future retirement needs of the people that you are investing on behalf of. So that's one example. A foundation, for example, might say, my objective is I need to give out X amount of grants. And so I need to give out X amount of grants. And you go, okay, well, if you give out X amount of grants, are you allowed to deplete your corpus? They say, oh, no, we're not allowed to deplete our corpus. Okay, so you need X amount of grants, but it has to be in addition to what you already have. So you have to make that money. And then what about inflation? Do you need to be able to keep up with inflation as well? So once you can actually define what it is you're trying to achieve with your investments, then you can come up with the number, and then you can manage towards that, right? And so if you first start with the objective, then you look at and you say, all right, so then what is our risk measure, and how are we going to measure risk in the portfolio? Because SAA would be allocating dollars, whereas if you have a risk budget that is agreed upon, then you allocate towards volatility or risk. And then the final piece is what's my risk tolerance? How much am I willing to lose in a month period? And then so from there you can basically create some parameters around, where can I go? What can I do? And it enables you to make the map clearer, I think. Now, that said, it's much easier to do from a blank piece of paper than it is from a $200 billion institution.
Is that an understatement, Alexandra?
So we just talk about these being concepts, and what we talk about are completion portfolios, because unless you are Ontario Teachers and you have a 50-person risk team who can analyze all of this data and manage everything to the nth degree, you're probably going to be taking a bit of a guess at some of the things. But essentially what we would say is that there is equity market risk, there is fixed income risk, and then there is inflation risk. And then what you should also be doing is trying to get some uncorrelated returns, which if you do that, and that's from harvesting factors or risk premia, if you do that, you can essentially increase your performance for the same level of risk, or reduce your risk for the same level of performance. And what we find is the 60-40 portfolio is when people have equities and fixed income, and everyone's saying, all right, well now that's just not going to cut the mustard for the next period, because inflation is rising, equities and fixed income are becoming more correlated. We need some uncorrelated returns to make sure that everything doesn't sort of crash at the same time. And so what we say is that what most funds need to look at is whether or not they have inflation protection, and whether or not they have an uncorrelated diversified stream, like a market neutral stream of returns. Now, then of course there's all of the alpha. Very difficult to find. If you can find it, go for gold.
What type of amazing? What and you don't have to give any specifics. Some of them that you drew out was like a teacher's fund, maybe a pension, but in general, like what type of institutions and or just organizations, like who, or foundations, like what's normally a good fit to work with you and your team?
Anybody really. So we have off the shelf products that have been designed for. We have a family office in the Nordics that we have designed a total portfolio fund for, and that has an equity, fixed income, inflation protection, and uncorrelated strategies, because the founders of this fund have a huge amount of exposure to unlisted real assets, and that was the business. And so quite often a family when they are looking to, if they have a liquidity event, they will have built a business. It could be manufacturing, it could be tech, it could
Sure.
be whatever. But you probably don't want more of that if that's what you've made your money from. So
Right.
buying something off the shelf like that for a family office gives you access to all of those different drivers that will get you pretty good returns, but it will also really protect you on the downside. Then
Mm.
we do, because we're quants and we love solving problems,
Mhm.
we do customization. So for the biggest institutional investors, they might say, all right, well, I don't need your market neutral thing with the 10 risk premium because I've already got 5 of those from someone else, but I really like the fixed income and commodity strategies. Can I just carve those out? And we're like, of course you can. So because everything in our business is based on a building block approach, we can extract and customize for our investors.
Mm. Amazing. Alexandra, this has been a lot of fun having you on today and learning more about your work and your approach. Last question. I know you mentioned that you put out a post on LinkedIn, and I don't know if there's
Yes.
other content you put out, but how can the listeners, follow up, learn more about, of course, the organization, but also if they want to follow your work and otherwise?
Yeah, so on LinkedIn, that's my main platform. Everything I do there is my own voice, but
Hmm.
as I said, I'm a storyteller or a marketer rather than a quant. And so what I try and do is I make very complex investment strategies or things quite simple to understand. So if
Mm.
you're interested in learning about total portfolio approach, what the components are, factor investing, what a factor is, etc. I do some infographics and I try and make that easy to understand in bite-sized pieces. So
Hmm.
people are very welcome to contact me and reach out over LinkedIn.
Fantastic. And for everybody listening, just so you know, we'll definitely put some links in the show notes so that you can just click on the link and head right on over and connect with Alexandra. And speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. You heard me right. Each and every day, we're bringing you new content, new ideas, and hopefully new inspiration to help you along the way in your journey as well. So hit that subscribe or follow button. And Alexandra, it's been an absolute pleasure. Thanks for coming on.